Hello and welcome to another episode of Full Court Finance here at Zacks. I'm your host, Ben Rains. And today we're taking a look at two stocks trading at least 30% below their highs to consider buying in December for long-term growth upside. And those two stocks we're looking at today are Global Payments, which trades in the ticker GPN, and DexCom, which trades in the ticker DXCM. But before we get into everything, remember to subscribe and leave a review wherever you listen to your podcast, and make sure to check out our Zacks.com/promo page for a look into some of our services, portfolios, and more. All right, so before we jump into these two stocks, it's worth just kind of going over quickly where the broader market stands as we start December. So the broader market kind of has gone on a prolonged, relatively horizontal move over the last roughly 2+ weeks. The period of stagnation is actually pretty welcome in my book and most people's books, as the calm kind of helps the market die down a little bit and prevent it from getting a little bit too overheated too quickly, because if stocks go up too far, too fast, they're more likely to fall quickly in the near term as well. It's also worth stressing that seemingly the limited number of sellers is rather bullish as investors attempt to stay exposed to the possibility of a prolonged rally to new highs during the coming months. So the strong GDP data that we saw earlier this week signaled that some in the U.S. think we're headed for a soft landing. Others then seem to think the U.S. economy is headed towards a recession in the somewhat near term, as consumer spending finally appears like it could be fading after that prolonged boom. Either way, though, the big money is warming to the idea that the Fed is going to start lowering rates in the back half of 2024 to either slowly start to quote unquote normalize the interest rate environment or accommodate a slowing economy. The quiet stretch for the market actually came after that October CPI release, and then everyone was looking at that PCE release, which is the Fed's preferred inflation gauge, on Thursday. Nothing crazy there, so it didn't spark any big moves in either direction. So we could see Wall Street kind of do more choppy trading until November's CPI release, which is due out on December 12th. And then after that, maybe it's possible the next major market catalysts aren't coming until the fourth quarter earnings season, which kicks off in January. So with that said, the NASDAQ has kind of moved sideways since that initial surge. So it's still trying to edge back up towards those summer highs. And if yields continue to fall, both the S&P 500 and the NASDAQ in the broader market should be able to slowly march higher in December and then in the early part of 2024. So with that in mind, the first stock I'm going to look at is Global Payments, which trades the ticker GPN. So Global Payments is as its name sounds, it's a payment technology company. It operates in three different reportable segments. So it's Merchant Solutions, which is the largest segment in 2022. It was about 69% of adjusted revenue, and then Issuer Solutions about 24%, and then Consumer Solutions is by far the smallest segment, rounding out the rest of that. So Merchant Solutions offer payment and technology and software solutions. The payment tech enables its customers to accept credit cards, check, digital payments, and its software solutions help streamline business operations for customers in numerous vertical markets. Its Issuers Solution segment provides services that help financial institutions and other financial service providers to manage their credit or their card portfolios, minimize technical complexity and overhead, and try to overall extend the seamless experience for cardholders on a single platform. And then its Consumer Solutions provides a general purpose, reloadable prepaid debit and credit cards, payroll cards, demand deposit accounts, and other financial service solutions to the quote unquote kind of underbanked and other consumers. So overall, yeah, it's a Global Payments is a payment technology company that's been growing for a long period of time, and it's made some acquisitions in the last several years as well, including the buyout of a leading payment technology service provider, EVO Payments, EVO, in late March of 2023. The company's also focused on various strategic partnerships. It has a nice partnership with Alphabet as well. And most recently, Global Payments beat our Q3 earnings estimate and raised its view at the end of October. So looking ahead, overall, we're calling for about a little bit over 7% revenue growth this year to get up to about $8.7 billion, and then another 7% revenue growth next year to get over $9.3 billion. And then on the bottom line, we're calling for 12% adjusted earnings growth this year, and then another 14% adjusted earnings growth next year. And in terms of the top line growth, this comes on top of about 5% growth last year, 15% growth in 2021, 51% growth in 2020, 46% growth in 2019, down year in 2018, but then 44% growth before that. So obviously a slowdown after that rapid period of expansion, but still solid 7% growth back-to-back years on top of all of that massive growth over the last 4 or 5 years. Global Payments currently lands a Zacks ranked number 3 hold right now, with its earnings revisions having kind of moved sideways recently, but its outlook calls for stable growth, and it pays a dividend with a really nice payout ratio of just 10%. Overall, the stock's climbed about 270% over the last 10 years versus the Zacks tech sector's 240%. And that is despite the fact that Global Payment shares have not really recovered yet at all. The stock is still down over 45% or roughly 45% from its 2021 highs, and it's only up about 17% in 2023 versus the broader tech sector's 46% run. So at about $116 per share, as I'm recording this, it trades about 21% below its average Zacks price target as well. The stock is also now back above its 200-day and 50-day moving averages, which is a positive sign. And then on the longer term, it's back above its 50-week moving average. So it had been under there for much of the last relatively year and a half plus. So it's back up above that key level, having been rejected there a bunch of times in 2022 and early 2023. So now it's back above that level once again, which is a good sign. And it's trading at about 10.5 times forward 12-month earnings, which is 65% below its 10-year highs and at a 50% discount to its median. And it's trading at 60% value versus the broader Zacks tech sector, even though it's outperformed that space over the last 10 years. It's actually at its lowest levels, or relatively lowest levels, slightly above its recent lows over the last 10 years. So as I said, it's trading at just 10.6 or 10.5 times forward 12-month earnings versus the tech sector, which is trading at about 24.7 times forward 12-month earnings. And then in terms of Wall Street, the stock, they're still pretty high in the stock overall. So of the 30 brokerage recommendations that Zacks has, we only have 1 strong sell alongside 21 strong buys and 3 buys and 5 holds. Overall, Wall Street's still really high in Global Payments, and it might be worth considering the stock at the moment if you're a longer-term investor looking to get in on a payment technology company that has not rebounded in a big way and is trading at a pretty solid valuation level compared to its own historic averages and the broader Zacks tech sector. Now we're going to transition to a different company completely, in the sense that it operates just as far away from the payment space as you could, while still being kind of an innovative, tech-focused healthcare company, and that is the connected medical device standout DexCom, which trades in the ticker DXCM. It's posted really steadily massive year-over-year growth recently as more people in the U.S. and globally suffer from diabetes. It posted impressive results recently in terms of Q3 results, and the stock is still down 30% from its 2021 highs, even though it has been a standout in that connected health world, and it's already been on a big rebound since its early October low. So it's still trading 30% below its overall 2021 highs, and it's already bounced back in a big way recently. So let's kind of just jump into what DexCom does. It makes continuous glucose monitoring devices designed for people with both type 1 and type 2 diabetes. The connected health firm also allows people with diabetes the opportunity to place a small sensor on their bodies to help them continuously monitor those glucose levels in real time and avoid those dreaded finger pricks. It also gives users and caregivers and really anyone else who's involved in that situation to be able to monitor those levels on various compatible smart devices and wearables. And the goal is to basically help everyone make their decisions better in the moment with more accurate information. And the device helps people manage their diabetes just more simply than in the past. Overall, the continuous glucose monitoring systems are part of this connected health revolution that appears to be on the verge of becoming standard care in treatment in the future. And its addressable market is just growing rapidly, with about 1 in 10 people in the U.S. already having diabetes. And there's far more people that have, quote, pre-diabetes, and this is according to the CDC. Plus, rising diabetes rates are not just a U.S. issue. Roughly 1 in 10 people globally are living with diabetes and counting. And we should note that some of its devices are currently covered by Medicare for people who meet certain criteria. The company is also expanding its reach far beyond the U.S., which is a good sign. So the company is projected to post about 24% sales growth in 2023 and then another 18% higher revenue growth in 2024. To get to about $4.3 billion based on the most recent Zacks estimates. And this top line growth follows about 26% average expansion during the trailing 3 years, and even stronger sales growth prior to that. Meanwhile, we're calling for adjusted earnings growth of 64% this year and then another 18% higher next year. And it boasts an impressive history of bottom line beats, including a 47% beat in late October, when it beat our Q3 earnings estimates, and its positive earnings outlook helps it land a Zacks rank number 2 buy at the moment. With, as I said, those outlooks for 2023, 2024, and now 2025 trending heavily in the right direction. In terms of some of its price performance, its shares are up 4,600% during the last 20 years and about 1,200% over the last 10 years, versus the S&P 500. It's roughly 160% run during the last decade. More recently, it's up about 240% over the last 5 years, so still on a really nice run. And despite that really impressive run, it is, as I said, trading around 30% below its highs and still 10% below its average price target, even though it's soared 50% since October 12th. And they're still trading around 15% below their summer 2023 high. So overall, the stock's still trading 30% below its all-time highs in 2021, 10% under its Zacks price target, and still 15% below where it was even just this summer in 2023. And that's despite the fact that it's already surged about 50% since early October. The stock found support around its 50-month moving average, which it had only broken below a few times over the last 15 years. So it's back above that key, really long-term moving average. It's also still trading at some of its most historically oversold RSI levels, even though it's back above both its 50-week and 200-week moving averages as well. So these other longer-term moving averages. The stock's also now trading back above its 200-day and its 50-day. But on a more near-term level, it is, after this big surge up 50% since early October, it is near some more near-term overbought RSI levels. So we could see a little bit of a pullback or at least some sideways movement for DexCom in the near term. That said, it's trading at a 20% discount to its own 3-year median with a PEG ratio of about 2.1, which is near the tech sector. And this factors in its longer-term earnings growth outlook. That said, one of the glaring drawbacks and why some people might not want to touch DexCom if you're not a big-time growth investor or you don't believe in its long-term outlook is that it's, especially in this newer interest rate environment, is that it's trading at about 70 times forward 12-month earnings versus the tech sector's 24 times. So if you're willing to pay up for it, that's there. And then if you look in terms of its longer term earnings outlook, that's what that PEG ratio is. And it's trading more closely to being in line with the broader tech sector. We should also note that the company announced a $500 million share repurchase program when it reported its Q3 results in late October. It also has a pretty strong balance sheet, which is good to see. And Wall Street's still really high on the stock with 17 of the 19 brokerage recommendations that Zacks has coming in at strong buy. So it certainly seems like it has a long-term growth trajectory as its business is able to expand as more people have diabetes. And once you have it, kind of have to keep using DexCom services. And it's possible that they could grow into other various aspects of the connected health world, especially with that strong balance sheet. So that does it for another episode of Full Court Finance. Until next time, I'm your host, Ben Rains. And remember, if you have any questions, please feel free to shoot us an email over podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.